Knowing when to start when investing can be extremely daunting for new investors. When we consider there's stocks, REITs, index funds, knowing where to start and how to build a portfolio can be tough. And that's what I'm here to help you guys with in today's video. You guys have probably heard of value investing, but what does it actually mean to be a value investor? Because this is one of the most important factors when you're creating a portfolio. And how to build a portfolio has to revolve around that main thing, which is value investing. Defining value investing can be tough, but this is the best definition I've seen in a while. Value investing is an investment strategy that involves picking stocks that appear to be trading for less than their intrinsic or book value. And the market tends to overreact or underreact to good or bad news, which doesn't correspond to a company's long-term fundamentals. This overreaction offers an opportunity to buy stocks at great discounts. To add, when talking about value investing, it would be rude not to talk about the likes of Warren Buffett and Michael Burry. These experts are amazing at building portfolios that are driven primarily through value investing philosophies. We are talking fantastic portfolios where these guys are achieving over 20% annually compounded for years. So I'm not expecting for us to build a portfolio that good just yet, but how about we try just beating the market that has returned 10% annually for the last 40 to 50 years? Because that is definitely possible with the use of value investing. And this is going to show you how to build a portfolio that can match the market and even beat it. Before I get into my main video, make sure to check out my Patreon account. Link is in the description. Here you'll be able to see all my recent stock moves and new stocks that I'm looking into. Let's talk about building a portfolio and how many stocks we need to get started. Well, the recommended can be anywhere between 10 to 20 stocks, depending on how risk favorable you are or how risk adverse you are. These factors you need to consider when building out your portfolio, and there's advantages and disadvantages, which is exactly what I'm going to get into. Now, there's lots of different advantages and disadvantages when talking about the number of stocks that you're wanting in your portfolio. Now, when considering you wanting a large amount of stocks, so let's say anywhere between 20 to 30 stocks, the advantages of this is you are spreading the risk over these 30 companies. And that means that you have less exposure to when the market is more volatile. This means you'll be more protected, but this can also impact your upside because you're spreading your upside risk as well as your downside risk. So you will have a much less volatile portfolio, but this can be a very helpful and help people sleep at night if they're particularly worried about losing money. So the disadvantages of this can be when you're managing 20 to 30 stocks, you have to manage these 20 or 30 stocks. That means you need to keep up with them. You need to make sure that you've got the right allocation for each and follow what the stocks are doing all day, every day. And that can be extremely time consuming and also challenging from just managing this amount of stocks. So that's why I recommend slightly lower to begin with. I think anywhere between 10 to 20 is more manageable. And the reason for this smaller part is one, you're dealing with smaller money as a beginner. And because you're dealing with smaller money, you want a more volatile portfolio to move the needle a bit for you. You know, if you've got £1,000 invested, spreading it over 30 companies for £50 isn't going to do too much. But let's say you have 10 stocks, £100 each, suddenly you can move the needle a bit more. And that's a benefit of having a smaller portfolio, is that it can be more volatile, but it can benefit you in the long term. Now, obviously it can work the other way. The lack of diversification can become more risky, but at the start, I recommend having a smaller portfolio amount. I think this will help with your volatility and understanding to manage more stocks as you get on. So now we've covered off how many stocks we need to understand what diversification actually means, because there's 3 different ways to diversify a portfolio which can help with the management and volatility in your portfolio. So the 3 ways to diversify your portfolio are through industries, countries, and market caps. And these 3 enable you to spread that risk and volatility of your portfolio. So we can see the examples of how this would work. So when we're considering different industries, we're talking about maybe the tech sector or retail sector or pharmaceutical sector. 3 sectors that clearly don't clash. Some can be defensive, some can be more growth orientated, such as tech. So there's very different ways in which they move in terms of volatility. Then we have countries, of course, very self-explanatory. We're talking US companies, UK companies, Chinese companies, all these three can vary in business cycles, and this can help with volatility and performance depending on which country is performing better and how much you're allocating to which industry or country. Then we're talking about market caps. We have small, medium, and large caps. Small caps tend to range between the $0 to $1 billion mark. Then we go to medium caps, which can be anything from over 1 billion all the way to 100 billion. Then we're talking closer to large caps now, from really anything. It can be from 50 billion all the way to 3 trillion to where Apple is. These three ways allow you to diversify a portfolio where smaller market caps can become more speculative and larger caps can still be speculative, but they tend to be less risk as the business gets larger. So this is three things that you need to consider, but diversification is so important. And now we know what diversification is, how do we find the right stocks to fit our portfolio with our diversification methods that we are now understanding of? Well, there's lots of different ways, whether or not you're using YouTube, Twitter, or just looking into the S&P 500. The main important thing is ensuring that we can discover the value within these businesses. And we do this through a methods of ways, but the next stage we're going to be talking about is the intrinsic value and how we work this out. Is intrinsic value, you may ask? Well, intrinsic value is a way of describing the perceived or true value of an asset. Now, it may not always be identical to the current value of the stock, but this is where we can work out whether or not an asset is undervalued or overvalued. And we use this through the fundamental analysis, which I'll be getting into now. So let's get into my intrinsic value formula now. It may look very complicated to a beginner, but I promise you guys that it's very simple. I'm also going to leave a link in the description so you guys can play around for this completely free. And the best thing about this is that you have three different ways to value your company. We have a base case. Now, this is the normal case in which you think the business can actually deliver its numbers. Then we have the best case. Obviously, the best case is when the business may outperform our expectations. So we may have higher growth rates that are associated with our best case. Then we have our worst case. This is obviously if the numbers are even worse than what we're expecting. And this gives us a little bit of a margin of safety of the intrinsic value we're expecting. So you can see in the formula, let's talk about the base case first. Well, their cash flow for 2023 is expected to be 5.5 billion. And as we're halfway through, I think it's pretty likely that 5.5 billion is pretty comfortable. And that's why I've got to sit for all three different scenarios. But the biggest difference is the growth rate you'll see on the right-hand side here. For my base case scenario, I have a growth rate of 10% for the next 5 years, assuming from the next 2023 all the way to 2028, that there's going to be a 10% growth rate. Then from the next 5 years, you're looking at a 5% growth rate compounded. And this gives us kind of a base case in terms of the intrinsic value, which it spits out, which will be $82.43. Then you'll also see on the side here, we have a discount rate. Well, the discount rate is something we need to add in terms of a margin of safety. Because the S&P has returned anywhere from 8 to 10%, we need to include a discount rate to ensure that we have some level of keeping the market the same in terms of performance. Then we have the terminal multiple. The terminal multiple is the multiple in which your stock will be trading at in 2030. Now, I have a multiple in my base case at a 20 PE, which I think would be fair considering the growth rate of around 10 to 5%, ranging from the next 5 years all the way from the 5 to 10 years. I think 20 could be reasonable, but if you wanted to, you could lower this and let's say it does 16. You can see this brings down the intrinsic value slightly to 157. And considering PayPal's trading at 72, I think you can see that PayPal is actually one of my stocks that I actually own. Then let's go into my best case now. Well, using our best case, it's a very similar formula, except for the main thing again is the growth rate. I've got PayPal growing 20% as my best case in the next 5 years, and then 12% from 5 to 10 years. And again, we always include that discount rate, which remains stable throughout all three models. But my terminal rate is slightly higher. If it's the best case and they're continually growing at 12%, you can see that it spits out an intrinsic value of $341, which is obviously a very large number to where the stock is trading at today. Then we have our scenario number 3, our worst case scenario. And this is where numbers are underperformed. And I've got them performing at a growth rate of 7% in the next 5 years, 4% from the next 5 to 10, and then the discount rate remains even, but the terminal rate I've got much lower at only a 14 PE. Now, the average of the S&P, where the PE ratio is, anywhere ranges from 16 all the way to 18. So you can see that 14 is below this, which gives us a nice little bit of margin of safety. And then when we scroll down, we can see the sum, which is kind of the mean average of the 3 combined, spits out a $155 intrinsic value, depending on the different probabilities I have as well. You can see there. And this is a basic kind of quick overview of intrinsic value formula that you guys can play around with for all the different stocks that you're going to be looking into. So now we understand what intrinsic value and how the 3 different bases work. There are still other factors to consider when picking stocks and building out your portfolio. We need to consider financials of a company. So this will include the balance sheet, the income statement, and the cash flow statement that will allow us to give us a better picture of a company's financial health situation. And this is just another factor we need to consider when buying a company and building it into our own portfolio. Now, to add, another factor when picking stocks for your portfolio has to be qualitative measures, and this includes management. You want to be looking at an experienced management team that are executing well. If you're not looking at the management team, you're not looking into a business, because the CEO is the most important person in the business, and looking into their vision and what they're doing to execute is an extremely important thing when buying a business. Whether or not they have huge share compensation can be a great incentive for businesses to perform better. So this is just another factor we need to consider when looking into our stock performance and our stock portfolio. Where can I actually build my portfolio? Well, there's lots of different trading apps, whether or not you're using eToro, Trading 212, Robinhood if you're in America, Webull. There's lots of different brokerages which enable you to buy stocks and build that portfolio from the start. And if I get into my Trading 212, we can see how this would look in terms of a portfolio in your account. So apps like Trading 212 make it so simple for the investor to start building out their portfolio, even though this is just kind of the building blocks of where you're going to actually put your money in as a brokerage. You need to understand what you're buying first, because I think that is the main important thing. But when looking at what your portfolio would look like, you would have your portfolio balance here, and then you'd have all your stocks on the left in which you can track the performance of how they're doing. Now, this is just a demo account, so I just thought I'd demonstrate using this, but it's a really effective tool in terms of managing your portfolio, because this is where you're going to be buying and selling the stocks, which is the most important thing of all. Other apps I can't live without is Ticker, because this is a place where you can work out all the different financial information, whether it's from the income statement, balance sheet, or cash flow statement. They also have the valuation of what the multiple is trading at on the right-hand side here. And they even have the estimates, what you're going to be expecting into 2024 and beyond if you want to pay for this service. So this is an extremely important website to use when valuing stocks. And I'll leave a link in the description so you guys can check it out, so you have everything there for your value. Now, in summary, you should have all the weapons in order to build your monster portfolio. Ensuring that you have a diversified portfolio is extremely important. Deciding whether or not you want 10 to 20 stocks, what industries, countries, market caps you're looking at, you need to understand what your risk tolerance is first and foremost. Ensuring that you have that basis, you can then go away, look for your stocks, whether it's on YouTube, Twitter, Facebook, wherever you're looking. You can then use my intrinsic calculator to work out some perceived value of that asset based on the assumptions that you're putting in yourself. Everything you're doing will be down to yourself. So don't sell yourself short, because you are the most important factor when picking your stocks. You need to ensure that you're looking at the financial health of the company, whether it's the income statement, balance sheet, cash flow statement. These are all important factors when picking the right stocks for your portfolio. Then the qualitative standpoint, you need to be looking into the management, the execution, all these different sections all combine together to build that bulletproof portfolio. And that's going to be the most important thing, finding the value, buying underneath it, and then you can become a value investor. And this is the most important thing because we're considering everyone is a value investor when we consider growth, dividends, everything is all about value investing at the end of the day. We want to buy an asset that is undervalued to deliver more than the market and hopefully come somewhere close to Warren Buffett within the next 50 to 100 or 1,000 years, maybe. We'll see. But if you guys enjoyed this video, make sure to leave it a like, subscribe if you haven't already, and make sure to check out my Patreon to see all my stock news, as I mentioned before. And I'll see you guys in the next one.